Hello and welcome to this month's market update. I'm joined by Ian Yun, member of our capital markets and asset allocation team. Hi Ian.
Hi Carla.
Thanks for joining us. So aside from summits in Sentosa, is there any news on the global markets and economy?
So the global economy has improved considerably over the last 12 months. You can see that from unemployment rates globally have steadily declined over the last year, and also business and consumer confidence are at high levels across the world. So central banks are dealing with this economic growth, and they are slowly shifting their monetary policies. As you know, after many years of low interest rates and quantitative easing, now it's slowly changing. As you can see from the US Federal Reserve increasing interest rates, the market is expecting more rate hikes this year, and other regions like Europe and Japan, they will also follow this normalization process over the years, although it will be very gradual. About the market, we had a material correction in financial markets earlier this year, but the performance of overall share markets globally has been very positive, largely thanks to the strong corporate earnings and the economic fundamentals helped drive the strong run in equities. On the flip side, though, the recent pickup in market volatility, it was largely driven by the concerns over higher than expected inflation and rising interest rates. And that's reflected in the increase in the government bond yields in the US. And lastly, the geopolitical risks remain heightened, such as Trump and North Korea, Iran and Saudi Arabia, and Brexit. So those continue to be in the headlines, and also Italy and some of the emerging markets, debt issues also need to be monitored.
Right, thanks Ian. Well, let's see if all this geopolitical uncertainty follows through to markets. And how about in the domestic market? We're coming up to 30 June. Is there any updates there?
So domestically, in the recently released GDP figure, it was very positive, with an annual growth rate of over 3% in the first quarter of this year. And we saw that the business conditions here have improved over the year, with a pickup in business and infrastructure investment, and also inflation has increased and job market has been improved. So those economic indicators say really good. I mean, the economy is doing really well, but we have a very low wage growth here. That's largely driven by underemployment rate remaining very high at the moment. So that indicates that it is likely to be a while longer until we see the wage growth accelerates. The Reserve Bank of Australia mentioned that if there is a rate movement, although it won't be happening anytime soon, it will be likely to be up due to the improvement in economic conditions here. But as we have noted several times before, the current very high level of household debt here in Australia remains a key risk.
Right. Well, let's see if the Reserve Bank takes some action in the new financial year. And how about in China, one of our trading partners? What's the update there?
About China, it's similar to our last update. In China, addressing the big run-up in debt has become a major priority for the Chinese government, and that likely means a slowdown in growth. However, we think the Chinese government will do whatever it can do, whatever it takes to avoid a hard landing like situation when it reforms the economy.
Great. Well, thanks. We'll keep a watching brief on that. Thank you very much for the update, Ian, and thank you to you for joining us.